Hi, Tower Talk listeners. We're going to get to this month's episode in just a minute, but before we do, I wanted to tell you about some of the topics we have coming up. In February, we're going to be talking about taxes and how they affect portfolio returns over time, just in time for tax season. And of course, we're going to tell you some simple ways to manage those taxes. Then in March, we're actually planning to have a live question and answer episode where listeners join us on the call and we answer your questions in real time. Mark your calendars. We're planning on March 19th at 6 p.m. Mountain Time, which is 8 p.m. Eastern. And send your questions in beforehand if you'd like, and we'll try to make sure we have the most thorough answer possible. All right. Now, if you've listened to Tower Talk before and you like what you hear, please like, subscribe, and share with your friend. Let's get to the episode.
Well, Happy New Year. We hope you all had a good time over Christmas with your families and got a good break. And now here we are to give you a little bit of a review of the past year, a little bit of a look ahead. And we're going to try and do this inside 10 minutes. So we'll see how well we are with our timer.
Absolutely.
If the dinger goes off, we'll just quit right then. Derek's going to take the first look at last year.
Absolutely. Okay, the first thing I want to start with is it might be hard to remember, but at the beginning of last year, all the headlines were talking about an impending recession. In fact, at the end of 22, you'll see, if you're watching this video, a couple headlines that show, hey, Canada headed for a recession, United States headed for the recession. And if you were a good listener of the Tower Talk podcast, we also predicted perhaps a mild recession in 2022.
No, we were wrong.
I know. Well, happy to be wrong in this case. We were wrong. We did predict a mild recession, and that didn't happen. Markets actually did extremely well in 2023. So we'll jump right in to the S&P 500. This is the 500 biggest companies in the United States, up 26% in 2023. Large returns. In Canada, the Toronto Stock Exchange was up 11.8%. So, strong showing there as well, not quite as strong. I think, though, what people, we'll jump into Tower's returns here in a second, but I think what people need to remember is that we need to also look at the 2-year returns because 2022 was a correction year. So, the headline number, for example, is the S&P 500 did 26%, but it actually did negative 18 in 22. So the 2-year return's only 3.4. And I'll be honest, at Tower, we're really happy if we don't take you on that 45% journey. We do not want you to go down 18 and up 26. That's not the journey we want to take you on, and that's not the journey we took you on. We're going to talk about the returns in a second here, and I'm happy to say our 2-year returns are better or similar, and we didn't have to go 45% to get there.
Now, that 3.4 is a 2-year cumulative return, right, Tarek?
Yeah, that's right, actually. Yep.
So per year, that's 1.7% on the S&P 500, and the TSX compared to that did 2.6% per year. Okay,
right,
1.7 and 2.6.
Yeah.
Annually. Now, annually, our momentum, which is sort of our performance fund, did 6.4%.
That's right. In the 2 years.
I would, for each year in the 2 years, that's better than 1.7 and 2.6. We like that. And our aggressive growth did 2.6 per year, which is really, really comparable to the TSX and better than the S&P 500 per year over 2 years. And our growth did 1.9. And the reason that it's lower, although that still exceeds the S&P 500, it underperformed the TSX. But the reason is we had in the growth, we have how much fixed income? Probably 40%.
35% fixed income.
35% fixed income in that one, which helps give it a little bit of stability and ballast. But the 02, the bonds underperformed significantly. They had negative value or negative return, and then they recovered some in the second year. So that's the reason why our growth was under a little bit lower than the other two.
Okay, change in directions. In terms of highlights for the year, Mark and I actually just got off a call for the Conference Board of Canada. It was an interesting call looking forward for the year. They're making some predictions, a bunch of economists looking back at the year. And actually, speaking of the recession prediction, on the call, they did a poll of all the people on the call. And they said, what do you think for recession in Canada this year? It's 50-50, roughly. I think 48-52, 50-50, let's say, for, negative outlook for the year versus positive outlook. The host mentioned, though, they did the same poll the previous year, the previous January, And 80% of the respondents said recession in 23 for Canada. So it just goes to show these things are hard to predict. These things are just really difficult in the near term to look at. So as we look back at last year, we just have to remember this is where we kind of came in. Let's get into that mindset. A couple highlights though is, the one thing everybody was talking about, the one thing that was, on every news feed, it seems like, was AI. And we're not going to get too much into the details of what that means, but I just saw a stat. It's of the companies in the S&P 500. This is 500 companies in Q2 last year on their earnings calls. 177 of them mentioned AI. So that's, one third pushing up to a half maybe of the companies mentioning AI. And the 5-year average on that is 60. So, we're pushing triple the 5-year average. And it is the previous record of number of times it was mentioned is Q1 of last year. And it's 50% more than that in Q2. So AI was a huge thing last year. I think it'll still be a thing going forward. And maybe that's a good place to say, that's last year. Let's look forward. Or do you have anything else to talk about for last year?
No, let's look forward. I agree with you.
Okay, let's do it.
Shall I pick up looking ahead and then you jump in?
Yeah, let's do it.
Okay. Some of this is our own view. Some of this is from the Pedro Tunes, who is the chief economist at the conference board that Tarek and I just listened to. Number one, employment rate right now in Canada is low. Number two, GDP growth is stable, expected to be between 2.5% and 3%. Real GDP growth is expected to be 1%. That means the other part is inflation. In other words, inflation does appear by all measures to be coming down. It was 8% at year end 22. Wow. So increased interest rates have worked because inflation is now 4. Most people thinking that it's on its way to 2 or 1%. Very healthy. Prediction for this year, soft landing. Prediction in the US, which has, sort of ramifications for Canada, ripple effect, is that it'll be an election year, and almost always election years are good for the markets. Okay. Mm-hmm. With that said, this might not be a bad time for those of you who want to take some risk down. It might not be a bad time to begin moving more into fixed income. So talk about fixed income, and the way to implement this in your portfolio is for you to move from growth or aggressive growth on that, which is 60 and 80%. Bring it down to 65 and 80% equities. Bring those down to 50-50 if you like. Go ahead on debt.
So, if you were listening to Mark and I these last couple of years, we were very risk off bonds. And the reason was rates just weren't at a level where the yields were providing enough return to be useful, to be helping you reach your goals. And that is not the case anymore. I'll put up a graph here if you're watching, and you'll see rates currently on the long and the short end of the spectrum are at levels we haven't seen in probably a decade or so. And this is huge. So that means that, now you're going to get rewarded adequately for holding bonds. And what that also speaks to is we're saying that we're probably at the peak or close to the peak of the interest rate increase cycle. So as Mark mentioned, central banks increased rates to tackle inflation. Inflation isn't quite where they want it to be yet. Maybe there's another rate increase. I think we could see this as the peak, maybe even a rate decrease if the economy does sort of falter. And that means that, this is a good time to move into bonds because the yield you're going to get just by holding them is going to be strong compared to what it has been. And if rates do start to decrease, you'll also see that capital appreciation. So what Mark was mentioning about aggressive growth versus growth, the main difference between those two portfolios is that the growth portfolio doesn't have as much equity. It's got more fixed income. And so when fixed income is now in sort of a risk on position, if you will, it maybe makes sense to reduce the equity exposure, go to the fixed income exposure. If you think that's a good fit for you, reach out. Obviously, we're taking a look at the portfolios as well as we do annual reviews and touch base with you, and we can discuss those things together. I do think, I should mention as well, we've been doing the research and we're actually going to change up our bond holdings a little bit, taking advantage of the fact that we're at the height of this interest rate cycle. We're going to move into some investment grade corporate bonds, a little bit away from provincial and federal bonds or
Short-term,
government-backed bonds.
short-term government. Yeah.
Yeah, exactly. And try to get the duration out a little bit longer on that end as well. But that's kind of what we're projecting for bonds this year.
The other really important part of what's going on right now is the savings rate.
Mm.
One of the numbers that we saw on this call was the Canadian savings rate. And this is a really hard to believe number, but Canadians are saving 6%, or savings are growing at a rate of 6%. What that will do is it will cause interest rates to come down. It will buoy up or lift the economy. It will be very good for markets in the end, which means it might take a little time. But I remember sort of a couple decades ago when Japan was the juggernaut among the G7 countries. Their big ace in the hole was they've got high savings rates. That will do really, really good things for us in Canada and help us in our markets. I think that's it. Is there anything else you've got in mind, or should we hang up?
Well, I do think the only other thing I would want to touch on is maybe some predictions for the year. One of the things that's going to be interesting in 2024 is it's an election year. And I mean elections all over the world. There's 50 different countries that are having elections. Some have already passed, like Taiwan. Some are going to be a little less exciting, like Russia's having an election. We all know Mr. Putin's going to win that election handily. And obviously the big one is going to be the one in the States. I think you maybe mentioned it, getting the signal that we're at time. I think you maybe mentioned it, but election years are oftentimes stable. The incumbent wants things to be strong heading into the election cycle, but it also brings uncertainty. So something to watch there.
Yes. I won't go into the ditch about Canadian politics. I think most of you would have ideas on that too. So we'll just avoid that whole thing.
Absolutely.
US, can't believe Donald Trump is going to win this thing from jail or somewhere. But anyway, we'll leave that alone too. No comments. None of that.
Yeah, exactly.
Thank you all for your business.
We appreciate it.
Talk with you. Thank you. Yeah.
Talk to you soon.